What advice would you have? You guys have been through some ups and downs along the way. I think maybe when you originally filed to go public, then you took a private round with
Yep.
some like
We've been through everything.
structure
Oh,
around it.
lots of
Yeah.
ratchets everywhere.
So for CEOs and
Yeah.
for employees that maybe are looking at their stock price and they were trading at 100 times and now they're trading at, a ridiculous 8 times or
Yeah.
whatever.
Yeah, exactly.
Like what advice would you have for those employees
Yeah.
or the people, the rank and file that have gone through this journey today?
Well, I mean, the really bad news is don't expect to go back to the 100x. So doesn't mean you can't go back to that value. It's just that could be 5 years of work to get back to that valuation. Just, you got to keep doubling the company at a pretty reasonable rate. So I think I would look at historic norms and, whether that's 2006 to 15 or 18 or whatever you want to choose, and just say, where did SaaS trade? 6x, 8x, 10x, 12x. Those would all been very good valuations. Those were not sort of made up. It wasn't made up why those were the valuations. It all flows from how much profitability can a company have? What will people pay for that profitability? And then revenue is sort of just maybe a good proxy for how you can generate that. And then, there's a growth rate variable there. So the higher the growth rate, obviously the higher the multiple. But you have a lot of companies that have a really high growth rate where we still don't have a lot of visibility in what's the actual underlying profitability of those customers. So kind of even growth rate sort of masks some of the value creation that we see in the value. So the first thing is possibly, unfortunately, we should expect valuations to go down and in a sustainable way. But probably less for the employees and much more for the founders and people thinking about kind of building these businesses. I think focusing on just business fundamentals, and I would say that in the frothiest of times, but certainly now it's much more appropriate, which is, what's your customer acquisition cost? What's your profitability? What the unit economics of customers? You have to care about your gross margin. We have a lot of companies out there that are like 40% gross margin businesses, but they trade like they are 80% gross margin businesses. That's dangerous, because at some point that 40% difference means it's going to be much harder to get to real levels of profitability. And so I think this is some of the reckoning, which is like the market is starting to figure out what things actually have software economics and what things are software enabled businesses, but they still have the economics of whatever that historic kind of industry looks like. And that's a very different model than for how you can value a company and an asset. There's a reason that a Coca-Cola or Procter & Gamble, probably like 5 or 10%, operating margin businesses. I'm making that up, but those will not trade like a Microsoft, who has a 30 or 40% operating margin. And so you have to be kind of cognizant of like what's the underlying unit economics that your business model has, and then build the company that's appropriate to that.
And so do you think that in that sense, this is actually just a healthy reset, and it's going to be psychologically
Yes.
difficult, and it's going to have RSU implications
Yep.
or option implications and reset evaluations?
100%.
We're back to a steady state.
I don't know where we will be by Saturday and,
Yeah, sure.
and next week and the next couple of months, but the idea that we needed a correction and that is like, that's a good thing. And we need to have a more sustainable environment, a durable environment, things where again, the problem with having an investment that is, trading at 100x revenue, whether it's private or public market, is that's just, at some point, that's gambling that like the thing is going to be able to sustain that. And it's way better and way healthier to build an environment where, every day you show up, you build more value, you sell to more customers, you build a better company. And if you do that, if you do your work, the valuation will then incrementally sort of respond as a result of that. Otherwise, you're just paying for some company predicting what it's going to look like in 5 years from now, which again is speculation as opposed to, really investing in durable businesses.
If you were a private company right now and took a 100x, 200x ARR round,
Yeah.
right? Like, and one of the things that's interesting, and I talked a lot about this, but like public markets are consensus, and there's thousands of transactions a day,
Yep.
right? People agreeing on it. Private markets, all it takes is one to
Yep.
make the market, right? And if there's one person standing there that says you're worth $1 billion, you might be worth $1 billion.
And as everybody knows, with protections though on that investment.
the preferred,
and that's the little fine print on the whole thing that makes the whole thing kind of like useless as a valuation kind of methodology. Because
Totally.
like they can't lose money. So you could call the thing $10 billion. And if they can't lose money, then it doesn't really matter. That's just a certain amount of like, their just appetite for upside is, they just don't have as much appetite for upside. So but they still are protected on the downside. Keep going. Sorry.
Do you think private companies are a little overly precious about down rounds, given you have down days all the time and you have up days? And like, if you had taken one of these valuations, would you think about being proactive about maybe resetting the 409A and issuing options at a lower price, or resetting the valuation? Or is there too much of a psychological barrier associated with something around a down round and what that means for employees?
If I were being totally realistic, if I were in my shoes in that situation, I would probably be sensitive because
of the perception.
You have people you've hired under certain circumstances, and they have a certain belief in what the value is. So the thing is I'm actually firstly, I'm insanely optimistic about the future of software, and so if you have a 100x ARR multiple company as a private company, like, congrats, conserve that capital. Try whatever you can to maintain whatever growth rate you can, but do it more efficiently than you were initially anticipating. And if you pull it off, then there's a very possible chance you'll kind of grow into that valuation, and you just maybe won't have to go to market from a funding standpoint for an extra couple of years. And then when we reemerge and things are more sustainable, then you could do an up round in 3 years from now. But like, the worst position is you get that high valuation. You brought in $100 million of investment, and you're just, your quarterly, monthly burn rate is $5 million a month. I mean, then that's a very, very dangerous spot, in which case you will definitely experience a down round or something with crazy protections and ratchets that'll look so ugly you wouldn't want to participate in that. But I think that, like, I would say people that are fundraising now obviously expect lower valuations. People that just fundraised, keep that cash, get more efficient, and see if you can kind of, just work through this environment.
Got it. Well, you recently tweeted it's counterintuitive, but raising less money will often lead to building a better business. It forces you to have constraints, which leads to more focus and higher quality decisions, which results in better product and more sustainable business models. So that's bad for my business model, right?
Yeah, you have to deploy capital.
That's actually really bad advice, and
yeah.
I don't think that's true. No, but what are the constraints when you're operating in the like public markets? You have to show cash flow, and there's trade-offs associated with that. How have you actually seen that manifest itself, and why might these constraints be good for entrepreneurs today?
So this took me a while. I had to like A/B test every possible thing, whether I knew it or not. And I can just say to anybody listening that is a founder or whatever, like, the constraints are actually lead to a better business. In the unconstrained environment, what you found, and we found this as well, as we needed to get more profitable, you would just see so many different sort of like projects emerge. And so like you've got a project that will pay off in a year from now. And then you got a project that'll pay off in 2 years from now, and a project that'll pay off in 5 years from now. And like instinctively, you're like, that's great. We're making lots of little bets, and we'll sort of see what plays out. But all of those little bets are taxes on the organization. It's meetings that people have to be a part of. It's coordination you have to be able to go and do. It's more people that have to be hired. It's more support infrastructure for all those initiatives. And then all of a sudden you kind of start to maybe be a bit less sort of judicious on your and disciplined on your decisions. Like, well, maybe that speculative future AR thing maybe could work. And so I'll throw 5 people on that. And you kind of, you start to you don't even have like then a real heuristic anymore for how to make decisions and what kind of investments to make. And so in that unconstrained environment where capital is free because you're not really getting diluted that much and it's abundant, you start to build up all of these little things across the organization. And that's actually will make your company worse off, because what people, really thrive on is clarity, alignment, focus, a clear plan, being able to execute in a sort of a kind of a very forceful way in a single direction. And the more kind of just distractions and chaos and meetings and integration syncs you have to do across the organization, that's going to slow you down. It's going to serve your customers less in sort of what they need from you today. It's going to kind of just reduce your ability to make good business judgment decisions. So I've generally found that having those constraints, and it can be in some cases, it can be truly arbitrary. You could just say, we're going to run the company at a 10% operating margin. And then every decision we make has to be made from the lens of what we have a scarce amount of resources. We're going to put that scarce amount of resources in the most impactful things. That will force you to rank and prioritize what is the most important set of things. That will let you channel your energy in those areas, which will actually likely lead to a higher predictability that it actually pays off.